Welcome to Thoughts on the Market. I'm Seth Carpenter, Morgan Stanley's Global Chief Economist.
And I'm Serena Tang, Morgan Stanley's Chief Global Cross-Asset Strategist.
And yesterday, Serena, you and I discussed Morgan Stanley's Global Economic Midyear Outlook. And today, I'm going to turn the tables on you, and we'll talk about asset markets. It's Tuesday, May 21st at 10 a.m. in New York. Okay, so yesterday, we talked about all sorts of different parts of the macro environment: disinflation, inflation, central bank policy, growth. But when you think about all of that macro backdrop, what does it mean to you for markets across the world?
I think the outlook laid out by your team of stable growth, disinflation, rate cuts, that is a great backdrop for risk assets. One of the reasons why we got overweight in global equities. Now, there will likely be low visibility and uncertainty beyond year end, and why we recommend investors should focus on the triple C's of cheap optionality, convexity, and carry. That very benign backdrop suggests more bullish possibilities. Your team has noted several times now that the patterns we're seeing now and what we expect have parallels to what happened in the mid-1990s when the Fed cut in small increments, U.S. growth was sustained at high levels, and the labor market was strong. Now, I'm not suggesting that this is 1990s and we should party like it, but just that the last time we found ourselves in this kind of benign macro environment, risk assets, actually most markets, did really well.
So I will say the 1990s was a pretty good decade for me. However, you mentioned some uncertainty ahead, low visibility. We titled our macroeconomic outlook, "Are We There Yet?" Because I agree, we do feel like we're on a path to something pretty good, but we're not out of the woods yet. So when you say there's some low visibility about where asset markets are going, maybe beyond year end, what do you mean by that?
I think there's less visibility going into 2025. And specifically, I'm talking about the U.S. elections. When I think about the range of possible outcomes, all I can confidently say is that it's wide, which I think you can see reflected in our strategist's latest forecast. Most teams actually have relatively constructive forecast returns for their assets in the base case, but there's an unusually wide gap between their bull and bear cases for bond and equity markets.
Let me narrow it down a little bit, because equity markets have actually performed pretty well during the first half of the year. So what do you think is going to happen specifically with equities going forward? How should we be thinking about equity markets per se?
Equities have rallied a lot, but we've actually gotten more bullish. I talked about the 3 C's of cheap optionality, convexity, and carry earlier, and I think European and Japanese equities really tick these boxes. Both of these markets also have above average dividend yields, especially for a dollar-based FX hedge investor. Where we think there might be some underperformance is really in EM equities, but it's a bit nuanced. Our China equity strategy team thinks that consensus mid-teens earnings growth expectation for this year will still likely to disappoint, given the Chinese growth forecast that you talked about yesterday.
All right, in that case, let me flip over to fixed income. A lot of that is often driven by central banks. Around the world, you just mentioned EM equities may be struggling a little bit. A lot of EM central banks are either cutting a little bit ahead of the Fed, but being cautious, worrying about not getting too far ahead of the Fed. So if that's what's going on with policy rates at the very front end of the curve, what's happening in fixed income more broadly?
We generally see government bond yields lower over the forecast horizon for 2 reasons. On your team's forecast of central banks cutting rates, and also in the U.S., an optical rise in the unemployment rate, our macro strategy team forecast for the 10-year U.S. Treasury yields to fall to just above 4% by the end of this year. And because government bond yields will be coming down, we also expect yields for spread products like agency MBS, investment grade, etc., to also come down. But I think for these spread products, returns can be positive beyond that duration piece. So credit loves moderation, and I think the mild growth backdrop your team is forecasting for is exactly that. U.S. fixed income more generally should also see renewed flows from Japanese investors as FX hedging costs come down over the next 6 months. All of this supports tighter than average spreads.
Okay, so you talked about equities, talked about fixed income. Big asset class that we haven't talked about yet are commodities. How bullish are you going into the summer? What do you think is going to go on? And can that bullish view that you guys have last even longer?
So for crude oil, our strategists see market tightness over the summer, which could drive Brent to about $19 per barrel. You have demand coming in stronger than expected, and of course, OPEC has extended its production agreement. But we also don't really expect prices to hold over the medium term. Non-OPEC supply should meet most of the global demand growth later this year and into 2025. Sort of leaves very little room for OPEC to unwind production cuts. We expect Brent to revert back steadily to its long-term anchor, which is probably somewhere around $80 per barrel. For copper, it's actually our metal strategist top pick right now, and it's very much driven by, I think, tightening supply and demand balance. You've had significant mine supply disruptions, but also better than expected demand and new drivers such as, we've talked about AI a lot, data centers and increasing participation. And on gold, in our view, pricing is likely to remain pretty choppy as investors have to weigh inflation risk, incoming data, and the Fed path. But historically, that first rate cut tends to be a very positive catalyst for gold. And we see risks more skewed to our bull case at the moment.
Okay, so talked about equities, talked about fixed income, talked about commodities. These are global markets. And often when investors are looking around the world and thinking about what it means for them, currencies come into it, and everybody's always going to be looking at the dollar. So why don't you run us through the Morgan Stanley view on where the US dollar is going to go over the rest of this year and maybe over the next 12 months?
The short answer is we see the dollar staying stronger for longer. Yes, we expect central banks to begin cutting this year, but the pace of cuts and ultimate destinations are likely to vary widely. Now, another potential dollar tailwind is an increased risk premium being priced for the 2024 U.S. elections. We think that investors may begin to price in material risks to dollar-positive changes in U.S. foreign and trade policy as the election approaches, which we assume will sort of begin ramping up in the third quarter.
All right, let's step back from the details. I want you to bring us home now. Give me some strategy. So where should people lean in? Where should we be looking for the best returns? And where do we need to be super cautious?
In our asset allocation recommendation, we recommend overweight in global equities, overweight in spread products, equal weight in commodities, and underweight in cash. We really like European and Japanese equities on the back of pretty strong earnings revision, attractive relative valuations, and good carry for a dollar-based investor. We like spread products. Not so much that our strategists are not expecting duration to do well. We are still expecting yields to come down. Where we are most cautious on really continues to be EM equities. From a very top-down perspective, the outlook we have is constructive. Stable growth, continued disinflation, rate cuts. These make for a good environment for risk assets. But uncertainties beyond year-end, that really argues for investors to look for assets which have those triple Cs, cheap optionality, convexity, and carry. And we think Japanese and European equities and spread products within fixed income tick those boxes.
All right. Looking at the clock, I'm going to have to cut you off there. I could talk to you all day. Thank you for coming in and letting me turn the tables relative to yesterday when you were asking me all the questions.
Great speaking with you, Seth. And yes, I know we can go on forever.
And thank you for listening. If you enjoy Thoughts on the Market, please leave us a review wherever you get your podcasts. And share this episode with a friend or a colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.